topic of this presentation is how short-term view of trading performance is often misleading. Have you ever got confused as to how two different traders may follow same trading methodology and still report differing returns? Some of them absolutely swear by that technique, whereas others call it to be rubbish. This happens because of very short-term view of trading performance you may take. What happens is price movement in market goes through various phases. Sometimes it goes into trend and sometimes it may remain sideways. At times it may happen that when a trader starts trading, the market is just moving into the phase which is going to be favorable to his method. Obviously he will be rewarded with fantastic profits. However, this phase is usually short-lived, and as market comes back to its usual course, trader starts making losses. Different traders may start trading at different times. In this article, we will systematically evaluate this phenomena and how, depending on when they start, may get different trading results. So to test this, I have written a trading strategy and I have applied on a sample trading commodities. So the equity curve of this system looks like this. The equity curve goes up, comes down, and it is more or less remaining near to zero. Sometimes it has made some profit. It has gone as high as $30,000, but again has come down. And in general, you will notice that this system is not a profit making strategy. It has close to 785 trades, so average trade profit will be in the range of something like $15 or $20. Now what we are going to do, we will give this system to 50 traders for trading. All these traders will be given exact entry and exit rules and also the position sizing rules. So position sizing means how many contracts should trade depending upon their capital size. We are presuming here that all traders are extremely disciplined. They will follow all the rules exactly as given to them 100% of the time. The starting capital is $30,000, and if account balance falls below $5,000, they will stop trading. But there is a twist. And that twist is trader number 1 will start trading from first trade. Trader number 2 will start trading from 11th trade in our trade sequence. Trader number 3 will start trading from 21st trade. And this way it will continue, and trader number 50 will start trading from 491th trade. So in summary, every new trader starts trading after 10 trades are executed by the previous trader. Now what I will be doing is I will compile the results for all these traders and track how their equity would have looked at the 30th trade, 60th trade and 100th trade. So the findings are summarized in this table. So it shows for trader 1, after he has executed 30 trades, his equity would have been $43,490. And after he would have executed 60 trades, his equity would have been $28,220. And after he has executed 100 trades, the equity would have been $15,300. So this is exactly reported for all these 50 traders. The cells which are highlighted in this green color show some impressive gains, whereas the cells which are highlighted in red color show that the balance has gone below $5,000 and therefore the traders have stopped trading. So some of the key conclusions we can draw from these findings is that most of the traders by 100 trade would have stopped trading. This is not a brainer because the system itself was really loss making. Some of the traders would have stopped trading as early as 30th trade, whereas some of them would have stopped by 60th trade. Now there are three instances of traders: trader number 22, trader number 30 and trader number 48. These three traders would have been lucky to start their trading exactly at the time when market was becoming favorable to their strategy. So trader number 22 made $89,440 by the end of 30th trade. His equity was $47,530 by the end of 60th trade. Similarly, for trader number 30th, his equity would have been $108,000 by 30th trade and $175,000 plus dollars by the end of 60th trade. The story of 40th trader would have been even more impressive, because he would have taken his equity to $155,000 plus and $352,000 plus dollars by 30th and 60th trade. But all these traders would have eventually blown up their account by taking their equity below $5,000 by 100th trade. Now the experience of this 40th trader would have been even more interesting to observe. By 30th trade, he has taken his equity by almost five-fold growth, and by 60th trade his equity would have reached almost up to 10-fold. So by 60th trade he would have started thinking that he has struck a gold mine, and he would have definitely made some plans to book a Porsche or some kind of independent house somewhere. But then what happened from 60th trade to 100th trade would have been a complete surprise to him, because in that period his account equity would have gone from $352,000 plus dollars to mere $1,270. So he would have always wondered how come a system that made him initially so much profit suddenly started making losses and ended up with $1,000 plus balance in his account. More interestingly, had you asked trader number 46 and trader number 48 opinion about this system, both of them would have given extremely opposite views, even though they just started 20 trades away. Trader number 46 would have ended up his account with mere $1,400 by 30th trade itself, whereas trader number 48 went on making substantial gains at least by 60th trade. And both of them were actually both disciplined and are giving true and fair view based on their own trading performance. So in summary, you may find two traders trading same method, and one absolutely liking it and another cursing it. Even if many traders start trading a losing system randomly at different point of time, some of them will make fantastic returns for a short time, but eventually losing it all. So it depends on the market phase when they start. These amazing returns made by some of them has no relevance in long-term trading. Long-term success in trading is not achieved by chance. It requires proper research, analysis, backtesting, and respect towards risk. So thank you for watching this video and happy trading. Before I close this presentation, something about Equinox. Equinox is a company based in Singapore providing premier trading education in the field of leverage trading instruments. The tools and techniques we teach in our trading courses are backed by solid research. In addition to above, Equinox also provides consultancy advice to traders on various topics like trading systems, evaluation, backtesting, money management, and portfolios. You can learn more about our courses and consultancy offerings by visiting our website www.tradingsystems.com.sg.